Greetings, ladies and gentlemen. On behalf of BMR partners, I'm pleased to host this webinar today titled Decoding Thin Capitalization Norms. I'm pleased to introduce you to my co-panelists, Ashutosh Dixit and Kalpesh Maru. Ashutosh is an off-counsel in the firm. He served for 25 years in the Indian Revenue Services and is an expert in international tax policy. Kalpesh Maru does substantial amount of work, is a partner in the firm in the area of international tax and also leads the firm's real estate practice. Today's webinar will attempt to decode the thin capitalization norms that were introduced in the Finance Bill of 2017. The thin capitalization rules is labeled as a reaction to BEPS Action Point 4. BEPS Action Point 4 rationale and preamble is something that I will discuss later, but more importantly, it is labeled as an anti-abuse provision because Section 94B, which deals with thin capitalization rules, is housed in Chapter 10, which essentially deals with all forms of tax abuse provisions under the Income Tax Act of 1961. Essentially, the preamble is to be able to curb abusive tax structures that are adopted by multinational enterprises to obtain seamless benefit from debt instruments. And my emphasis is on the term curb abusive tax structures because this is different than what has been stated as an underlying intent and preamble to Action Point 4 of BEPS. So let's try and look at some of the stated objectives of Action Point 4 of BEPS, which tends to move away from the term that I used earlier, curbing abusive tax structure using debt transaction. Action Point 4 essentially says that multinational enterprises who achieve favorable tax results by adjusting the amount of debt that they move across their borders. Action Point 4 also says that the tax rules and the location of the debt have a very important influence on how a multinational enterprise look at individual financing arrangements. It essentially envisages three types of scenarios. Scenario 1, where multinational enterprises groups place higher levels of third-party debt in high tax countries. The emphasis is on third-party debts, so you're really not dealing with related party transaction. In other words, the first scenario is that if a multinational enterprise has a third-party debt, but the debt is located in a high-tax country, Action Point 4 says you need to evaluate your country's domestic tax law for a legislation of this nature. The second scenario is where multinational enterprises use intra-company loans. Obviously, these are presumed to be related party transaction to generate an interest deduction in excess of group's actual third-party interest expense. In other words, it means that if a multinational enterprises has intra-company loan, it moves loans to countries to generate interest deduction, and at the group level, the interest deduction is more than actually the third-party interest expenses, then it makes out a compelling case to have a legislation of this nature. The third scenario that Action Point 4 deals with is groups that use third-party or intra-group financing, which is related party, to fund generation of tax-exempt income. In other words, you earn interest income in a jurisdiction which either has very low tax rate, which means you have an arbitrage, claim interest in a country which has high tax rate, or you generate an exempt income. The reason it is very important for us to understand the underlying scenarios under Action Point 4 is that then only you will be able to draw out a intelligent comparison as to how does India and how does Section 94B in particular stack up insofar as BEPS recommendation is concerned, because there is no doubt in anyone's mind that the only rationale and reason for India to legislate a legislation of this nature is BEPS Action Point 4. Now, taking all these three scenarios into consideration, The summary in action point 4 says that a recommended approach, there are 3 approaches that have been recommended in the entire report, but the most recommended approach is what they call it as a fixed ratio rule, by which you essentially limit net deductions that are available for interest or other forms of payments such as the guarantee payments. And they have given a broad range, or a band rather, between 10 and 30% of EBITDA, earnings before interest, tax, depreciation and amortization. Now obviously India has chosen the highest of limit at 30%, when we will try and debate this when we look at the analysis as to what does this legislation mean to you, but I'm just reading out the broad recommendations at the BEPS level. Now we found out from our research that the fixed ratio rule has been used in the thin cap legislations in countries such as Finland and Norway, but bear in mind that both these countries had these legislations in place prior to the BEPS Action 4 recommendation. And clearly this move is now seen as a articulation of India's view on adopting as many action steps as it can adopt, and we saw some of them in the budget of 2016 by way of country by country reporting and equalization levy, and now we are seeing 3 important changes in this year's budget. One is interest reduction, which is the subject matter of webinar today. We saw secondary adjustment and many more changes to come. Moving on, just in terms of setting the context, in slide number 4 essentially we have laid down the approach that is recommended by BEPS and the approach that India has adopted. I spoke about the limitations, the band of 10 to 30% recommended by action point 4 and India adopting 30%. Now in the BEPS action point 4 there is no recommendation insofar as the threshold limits are prescribed. India has come out with a recommendation that if the payments exceed 10 million rupees, 1 crore rupees, then you straight away attract this provision. There is no suggestion in BEPS action point 4 as to what needs to be done to excess interest deductions, but India has allowed a carry forward of 8 years. In other words, if you breach the 30% of interest EBITDA guideline, it will not be disallowed. It's not like transfer pricing. It will instead be carried forward. Now, there are several nuances that we want to deal with. Before I hand it over to my colleagues, I just wanted to make one mention that the BEPS action point doesn't specifically provide for any form of carve-outs, but it says that banking and insurance companies have to be excluded. India has adopted the same kind of banking and insurance company exclusion. However, the legislation as it reads doesn't prescribe by way of a delegated legislation any powers to the CBDT to have any carve-outs. In other words, if before the law is approved by the Parliament for its applicability from April 1, 2017, if those carve-outs do not feature in the amended provision, then the only exclusion that will be left out would be as it has been prescribed in the bill, which means that only banking and insurance companies will be left out. With that, I hand it over to my colleague Ashutosh to take us through the analysis of section 94B and the nuances that we have been able to analyze as part of our research.
Thank you, Mukesh. As you just mentioned, section 94B as proposed in the Finance Bill 2017, it sits in chapter 10, which are the anti-avoidance provisions under the Act. The proposed heading of that particular section as envisaged in the Finance Bill is limitation on interest deduction in certain cases. It's proposed that it will apply to incomes of financial year 17-18, therefore assessment year 18-19 and future years. The section itself broadly follows certain of the guidelines or the best practices recommended under BEPS Action 4 with certain exceptions as mentioned by Mukesh earlier. The first condition for a company to be first coming under these provisions is that the borrower is an Indian company or the permanent establishment of a foreign company. So that's the first condition. The second is that it pays interest or a similar consideration exceeding INR 10 million, which is deductible in computing income chargeable under the head profits and gains of business or profession. This interest which it pays is the interest which it pays to an associated entity, if that is in excess of 10 million INR. Then if these two conditions are met, then basically this particular company will be subject to certain other rules with regard to which its interest deductibility in its profit and loss account will be looked at. So what are those conditions? In respect of any debt issued by a non-resident being a AE. So the first is that a non-resident AE has issued a debt to this company. In respect of any debt which is issued by a lender which is not an AE, so the lender need not be an AE, a non-resident AE, but if an AE has provided an implicit or explicit guarantee to such lender, to such third-party lender, then that will also be covered as a debt which has been given by the AE. Or a third condition where the AE may deposit back-to-back a corresponding and matching amount with the third party who has given the loan to the Indian entity. So if any of these conditions are covered, then that debt is subject to Section 94B. Now, when we say that Section 94B, once this coverage comes in, the first thing is that the debt is defined, and we are going to the next slide on page 7, which is debt is defined to mean any loan, financial instrument, finance lease, financial derivative, or any arrangement that gives rise to interest, discounts, or other finance charges which are deductible under profits and gains from business or profession. I'm emphasizing the term which are deductible because this is a specific anti-avoidance rule. We also have transfer pricing regulations under which the interest payment to a non-resident AE is subject to certain qualifications, and therefore once we will come to certain slides where we will have to look at which of those qualifications will apply with respect to the deductibility under Section 94B. Then we are saying that AE as referred to above shall have the meaning assigned to it for transfer pricing related provisions, so that is the linkage with the transfer pricing provisions. Now the crucial part, what is going to be the disallowability? So the excess interest is what is going to be disallowed. Now what is this excess interest? So there are two thresholds. The total interest paid or payable in excess of 30% of earnings before interest, tax, depreciation and amortization of the borrower in the previous year. So that is your first threshold. You will look at 30%. Is the interest payment, total interest payment in excess of that? That excess amount you will hold as your first threshold. Then you will look at your interest paid or payable to your AEs for that previous year. You will compare the two, and the lower of the two will be what will be disallowed, in the sense that that interest will not be allowed as a deduction in your computation of profits and gains under business or profession. Now let me point out here that I am currently analyzing the provisions as per the finance bill. There is also the explanatory memorandum which explains the finance bill. There is a dissonance between what is written in the explanatory memorandum and what is written in the finance bill. My colleague Kalpesh will come to when he talks about the key considerations. But this dissonance between the two is something which is causing, I think, great anxiety to all taxpayers, and this is something on which the government needs to come out clearly even before it moves government amendments to the finance bill. Now the other part of this disallowance is that this is not a permanent disallowance. The interest disallowed in any particular year under this Section 94B, and I was talking about the thresholds and what that interest disallowance will be. Now that amount which is disallowed, it can be carried forward for 8 succeeding assessment years and set off against the business income subject to certain restrictions. Now, therefore, the carry forward provisions will also apply in this case. How they with other kinds of carry forward provisions, again, my colleague will be covering these intricacies in when he takes over subsequently on key considerations. Then, if we recall the BEPS recommendations, and as Mukesh explained, that they were talking about a separate kind of thin capitalization rules for specific sectors which deal entirely in money as an instrument itself, so the banking and the insurance sector. What the Section 94B does is that it excludes these two sectors, banking and insurance companies, from the provisions of Section 94B. Now, coming to the next slide, which is the key terms used in the section. One of the key terms which is used is guarantee, and when we're referring to guarantee, we're basically saying in that section that even if the debt which has been taken is from a third party entity, if that debt has been subject to an implicit or explicit guarantee by your associated entity, then the interest on that debt would also be considered for disallowance under this section. Now, this implicit or explicit guarantee, let us look at what we mean by this, because in legal parlance you only use the word guarantee. When you qualify it with implicit or explicit, then the Indian Contracts Act talks about what is a guarantee, and therefore that essentially would be what is an explicit guarantee. But then the question arises that can a pledge, a collateral, a surety, letter of comfort, reciprocal arrangements, can they be regarded as guarantees because you're using the word implicit guarantee? This is again very crucial because we are talking about MNE groups, and in today's globalized world, when a loan is given to an entity, there is always an implicit understanding that there is a whole group standing behind that entity. And therefore, although the provisions of Section 94B are supposed to be explicitly related only to interest paid to an AE, if the way we define this implicit guarantee, it could end up that all kinds of interest payments in an MNE group could stand to get covered. And therefore, it is very crucial that this is further qualified and this is further explained either through through government amendments to this bill or through further explanatory circulars. There has also been, in some senses, litigation on this point, although not under Section 94B, but under transfer pricing provisions. And Mukesh, would you like to brief us a bit about this issue of letter of comfort and guarantees?
Yeah, thanks Ashutosh. You know, this is a very interestingly worded law when we use the word implicit or explicit guarantee. And I just wanted to draw a comparison between implicit and explicit guarantee as stated in 94B versus the word guarantee that has been stated in Section 92 on transfer pricing, which has been a subject matter of debate. So what I can make out of it is that you don't need to term something a guarantee, which is an explicit guarantee. So if by the conduct of parties, it can be viewed as a guarantee, it would be covered under 94B. And that's really the reason why they have used the word implicit. So you need to read the word implicit along with the fact that BEPS is all about the intent of the parties. So if the intent of the parties was to have a guarantee, but they choose to call it a different word, let's say for example a letter of comfort, still this provision will trigger off. Now to some extent what the lawmakers and the drafters have done is they have done a smarter job just to be able to avoid falling into the trap that they fell into at the time they legislated Section 92 under Chapter 10 for transfer pricing purposes. And there are plethora of case laws that have happened in the context of the word guarantee used in the context of related party transaction, whether a letter of comfort would be guarantee or not a guarantee. Do we need to look into the conduct of the party? Do we actually need to look into the fact that that guarantee has actually been invoked? So what happens in a situation where there is merely a letter of comfort, and if for any reason the letter of comfort has to be resorted to at the time there is a breach, then it will become a guarantee. So until the time the breach has happened, will it be a guarantee or not for transfer pricing purposes? And the Delhi Tribunal and subsequently the Delhi High Court in the landmark Airtel's case took a view that you still need to have a real income theory in the context of what is a guarantee for a related party transaction. So I think now in the context of section 94B, all of that has been put to rest by using the word implicit and explicit, and hence taxpayers will have to be extremely cautious for this provision to get attracted. And just because calling something as not a guarantee, or just because wording it as a letter of comfort will not suffice in any manner, and hence the use of the word explicit and implicit now in my view broadens the ambit of the law insofar as the word guarantee is concerned.
Thank you, Mukesh, and that is therefore underlines the concern that when you are talking about multinational groups, to what extent can we carry this concept of implicit guarantee? Because could it result in a situation where all kinds of debt then get covered under section 94B, and therefore the urgency for either this implicit guarantee to be further explained in the provisions to provide certainty to taxpayers. As far as interest is concerned, it refers back to the current definition of interest already there under section 228A of the Act, and of course it would include any service fee or other charge which is paid in relation to that particular debt. And I would therefore now want to discuss this particular provision in relation to the General Anti-Avoidance Rule and the transfer pricing rules. And on that, let's first say that after a hiatus of a number of years, the General Anti-Avoidance Rule, which is section 95 and in chapter 10A, and it's therefore that section 95 just will be the section which is coming just after the section 94B. That General Anti-Avoidance Rule itself talks about disallowance of certain expenses or reallocation of income or reclassification of certain incomes if they are if they are for a purpose of tax avoidance. Now we also have a specific anti-avoidance rule in the context of transfer pricing provisions. The interest deductibility section which has been introduced in the finance bill, that interest deductibility section is also now a specific anti-avoidance rule. So we have now the interplay of two specific anti-avoidance rules, that is the transfer pricing rules, the proposed interest deductibility rule, and the General Anti-Avoidance Rule, which will, all of these will get triggered. The transfer pricing rules already in existence. The other two from financial year 2017-18, that is assessment year 18-19. So there has been a recent circular which has been issued by the tax authorities clarifying certain provisions of the General Anti-Avoidance Rule and how that would be applied. And in that circular it has been clarified that there should not be occasions to implement a GAAR where there is a SAR, but it doesn't rule out this entirely, and it has been stated that both GAAR and SAR can coexist on a premise that the SAR may not be able to address all situations of abuse. And therefore we will now have a situation where we could have both the transfer pricing as well as the section 94B interest deductibility applications, the two SARs, and then could a GAAR also be applied in such a situation. Because under GAAR an arrangement can be disregarded and necessary consequences can follow For example, the disallowance of the expenditure, the assessment of notional income, the reclassification of interest into dividends. And therefore, let's look at one or two proposals which we can have where we do not have maybe a final answer, but which we need to look at in the context of these new provisions which are coming in from next year. So first is the interplay of the two SARs, which is the transfer pricing and the section 94B, which is on the next slide, which is page 11. Now essentially, if you look at it, we are saying is that if under transfer pricing provisions, I have an adjustment on account of arm's length pricing of my interest, and because of that there is a disallowance of rupees 500, and then there is also a section 94B disallowance. Now will that 94B disallowance take into account that the interest has already been disallowed, and therefore when I apply the two thresholds, will that threshold apply to the interest which has already been disallowed, net of the disallowance and the transfer pricing, or will it still apply to what I have claimed in my profit and loss account? And therefore, essentially, if I take the view 1, that no, something has been already disallowed under transfer pricing provisions, and therefore one SAR has been applied, therefore the disallowance gets restricted to 500. That is one view. But if I look at section 94B, it talks about what is debited to the profit and loss account, and therefore if that view was to be taken, the stricter view, then my disallowance would still be the higher amount of rupees 900. We would definitely go for view 1 because these are two specific anti-avoidance rules, and it should not happen that a specific anti-avoidance rule should lead to a double disallowance, which has already been addressed by another specific anti-avoidance rule. But let us leave it at that. This also definitely needs clarification, and the clarification should be in line with view 1. Let us now also go to the next slide, which talks about the interplay of these specific anti-avoidance rules on transfer pricing and the interest deductibility rule, and they interplay with the general anti-avoidance rule. Now let me step back here. As Mukesh explained to you, the whole concept of the thin capitalization rule, or what you can also call as the interest deductibility rule, is that the way income is taxed globally, interest is more advantaged as compared to dividends. So because dividend payments are separately taxed, and interest is actually allowed as a deduction before you before you come to the profit which is to be distributed, and on which dividend distribution tax or a tax on dividend is to be levied. Therefore, in terms of tax planning in a multinational group, you would want to replace debt, you would want to replace your equity with debt, and therefore you would essentially have a highly geared structure, because that particular interest you would be allowed to deduct in your high tax jurisdiction, and you may be able to let that interest be taxed in a low tax jurisdiction, either at a zero rate or at a very low rate. Now if we are coming to that kind of a consideration, then the SAR is supposed to be actually intended to counter that, and therefore when I apply this interest deductibility provision as it is currently formulated in the finance bill, then if I say that the interest paid to the non-resident AE is at a 10% interest, and that is at 1,000 rupees my deduction, and under the transfer pricing provisions there is a TP adjustment for the arm's length price, because of which my deduction gets reduced to 500. And then after that, on top of that, there is also a disallowance under section 94B, and because of that, disallowance of the interest, that excess interest disallowed, is a further 200. So essentially what I end up is that against a claim of 1,000 rupee interest deduction, I finally get only a 300 rupee interest deduction by applying two separate SARs, which is one is the transfer pricing, the second is the interest deductibility provisions, which we are currently discussing under the thin cap rules. Now can somebody turn around and say is that I do not agree with the gearing of your particular structure, and since the gearing is much too high, I would still say that some of these debt, some of this debt or some of this equity is actually debt, and therefore the interest which you have paid should actually be subject to a dividend tax, which would be at a rate higher than what would be the withholding tax on the interest. Now, this is somewhat an open question. We would say that again, where I have applied 2 SARs, then at least to the extent that 700 rupees has already been disallowed to me as interest, that should never be reclassified as dividend. That of course is the view, and I think that is the view which one can take with a certain degree of certainty. But the other point is there are 2 open points here. One is that there could be certain hybrid instruments. Now whether that hybrid instrument itself is classified as debt or classified as equity, that is an open question when I apply GAAR. The second is that the second open issue is that even if I follow the 2 SARs, if I have a very, very highly geared structure like a 99:1 debt equity ratio, can somebody still then reclassify some of my interest which has not yet been disallowed, at least reclassify that as dividend and therefore subject it to a higher tax? We would leave the second question open because essentially this is, I think, something on which the tax authorities would need to come out with further guidance as they have already done under the current GAAR rules, because again there are a number of structures which have been used in India, and a number of these structures are for infrastructure projects, and all these stand to get impacted. When we talk about our takeaways, BMR takeaways, Mukesh will be touching on this particular topic too. Well, having covered this general topic on the interplay between these 2 SARs and the GAAR, I'll now hand over to my colleague Kalpesh to further talk about the key considerations which we have to keep in mind. Over to you, Kalpesh.
Thanks, Ashutosh. What we've done in this section is to look at some of the practical considerations in interpretation of this section and some of the related open issues that are there given the manner in which the section is worded. I think it's granted that the impact of the whole provision is going to be significant to taxpayers, and therefore we'll have to look at the implication from a practical point of view. What we've attempted to do in this section is to broadly deal with only 2 kinds of issues that we have, those that are dealing with the scope of the section, and a few pointers on the entire computational machinery where there seem to be some disconnects and lacunas in the language in which or the manner in which the sections have been enacted. So going straight into the scope of the section, as Ashutosh indicated, there are some threshold conditions that have been prescribed, upon the satisfaction of which the entire thin capitalization provisions of 94B triggers. We have attempted to capture this in a tabular format in order to decide and determine which of the relationships would get covered by the provisions of this section. I think what is fairly easy is where there is a loan from a non-resident related party to an Indian company, that squarely gets covered under the provisions of the Act, and therefore there is not that much of a debate in determining the applicability of this section. As is the case where the loan is from a resident related party and no guarantee has been provided on such loans, again it is fairly easy to rule out that provisions of 94B would not be applicable. Where it gets interesting is where a debt is from a non-resident lender who is unrelated, but such loan is thereafter either guaranteed by a resident AE or a non-resident AE. Now, in case of a non-resident associated enterprise guaranteeing a loan from another non-resident unrelated party, again I think the provisions are fairly clear and understandable, and the provisions of 94B apply. consider a situation where you have an infrastructure company which borrows money using any of the several permitted methods, including ECBs or masala bonds. And by definition of these instruments, these are and commercial convention, these are normally guaranteed by either the parent or the promoter of the Indian SPV that is generating the creating the infrastructure. In that situation, we are dealing with a case where the borrowing is from a non-resident, but a resident related party has guaranteed this loan. And if you think about it again in a very commercial context, this would typically apply pretty much to upwards of 70% of foreign debt from an unrelated party, because rarely do we practically a situation where a borrowing is granted by a non-resident which is not guaranteed by a related party, albeit an Indian parent of the SPV that is borrowing. As the law stands today, looks as if this would also get covered within the deeming fiction or an expansion to the provisions of 94B, because the provision that says that a borrowing from a non-resident is deemed to be treated as a related party borrowing if such debt is guaranteed by a resident by an AE, does not qualify or make a distinction between whether that AE is a resident or a non-resident. Therefore, while the intent of the provision may be about base shifting from a resident to non-resident situation where a non-resident AE guarantees it, as the provisions stand today, it seems like this will get covered within the ambit of 94B. Obviously, what this would mean is, from a commercial perspective, this is a large impact because the entire rigor of the provision would start applying to such debts. Moving on to a different scenario where the debt is from a resident and a non-resident AE is guaranteeing the debt. There, I think equally, while there is a ambiguity in the language or lack of absolute clarity, we are of the view that in case the borrowing is from a resident, on principles, this does not amount to base shifting and ought not to be covered, and the language of the section seems to sort of support this view as well. So therefore, in terms of the scope of section, we would flag out a non-resident debt from a related, which is guaranteed by a resident AE as a point that needs to be looked at in more detail. Moving on to slightly more exotic structures, within the Indian tax code, we have structures involving alternate investment funds, in which REITs, etc., which are in principle and theory designed to be a structure where the investment is made by a resident entity, typically set up as a trust, more often than not, and in some cases as an LLP. Therefore, when an Indian company borrows from such entities, the borrowing actually is from an Indian entity. But the unique nature of these entities are such that they operate on a pass-through, whereby the income in the hands of the non-resident is taxed as if it was a direct investment in the Indian company in the example that we have shown. So obviously this begs a question as to whether an arrangement of this nature would fall within the purview of 94B. And this is going to be an answer to this, or a clarity on this is going to be one of the key asks of the government at the time of enactment, because increasingly there are a lot of structures involving AIFs and hopefully REITs and InvITs will take off in due course. And this is a clarity that will be required in order to determine with reasonable certainty as to the outcomes of tax and the applicability of 94B in these situations. Moving on to more computational issues, as Ashutosh indicated in his earlier analysis of the section, there seems to be a clear and an apparent disconnect between the language of the bill and the manner in which the memorandum has been written out. We've sought to explain that in the form of a numerical illustration. So if you basically, the bill says there are two elements on the basis of which the disallowance is to take place. a total interest in excess of 30% of EBITDA or interest paid to the related party is sought to be disallowed, and that's the language as per the finance bill. Whereas when one looks at the memorandum which seeks to explain the provisions of the finance bill, the language is exactly the opposite. The memorandum seeks to explain what is sought to be allowed as a deduction, and just given the manner in which the language is written out, it appears that as per the memorandum, what will be allowed as a deduction will be interest up to 30% of EBITDA, related party interest up to 30% of EBITDA, or the whole of the interest paid to a related party is what is sought to be allowed by the memorandum, whereas the finance bill talks about a disallowance of the word total interest. Now, to put this in context, if you look at the illustration that we have outlined, where you are looking at a case of borrowings both from a related party and an unrelated party, the impact of these two different interpretations can be material, because you would see that a computation of the total disallowance on the basis of total interest less 30% of EBITDA, which is the table on the right hand side, results in a significant disallowance of 60 and 83 as compared to taking the interpretation as per the memorandum, where the disallowance would be restricted to 10 and 33 under the different assumptions that we have made. Albeit this is going to be one of the most crucial clarifications that we would seek at the time of enactment of the bill, because as you would see, the difference between the two is fairly material, and it would be important that the clarity on this in no uncertain and absolute terms is provided at the time of enactment. But our take, as we read the provisions of the bill as well as the memorandum, it seems that the view as per the finance bill, which is basically the table on the right side, it probably appears to be the better view, because from a computational machinery point of view, if the view as per the memorandum is taken into account, one limb of the whole computational machinery becomes irrelevant in terms of deciding the absolute disallowance. But be that as it may, we will have to wait for some clarity on this aspect at the time of enactment. The next issue deals with an even more fundamental question, to say that how would the provisions of section 94B operate? Would they operate to disallow the gross interest claimed by a company or on the basis of net interest? So we've again explained this in the form of an illustration. So if you look at the left hand side chart, we are looking at a company, a US company that has an India holding company, and there is debt that has been infused by the US entity into the Indian entity, which in turn has infused a part of the debt into a downstream subsidiary referred to as the borrower. Now, as far as applicability of section 94B to the interest deduction for the borrower is concerned, the borrower has borrowed money from an Indian company which is a resident, and therefore provisions of 94B ought not to apply. So we straight then jump into the applicability for the Indian company. Now, in the case of an Indian company, its net interest deduction that it is claiming is on 2 million, because 10 million is the interest deduction to the US interest payment to the US entity, but it is also receiving 8 million from the borrower, and the net deduction in the P&L is for 2 million. If the view is taken that the provisions of 94B in terms of computational machinery need to be computed having regard to the net interest, then the math would be, you would compare the 2 million net deduction claimed against 30% of EBITDA, and in that situation you will end up potentially getting a disallowance of a far lower number as compared to a situation where the interest deduction is claimed on the basis of a gross expenditure of 10 million. No clarity specifically on this, but from a practical perspective, the structure that we have outlined on the left side is typically the structure that is followed in the case of levered acquisitions, where an Indian holding company is inserted, very prevalent in the pharma sector, very prevalent in the infrastructure sectors, and to some extent also in the real estate space. So if in summary, if it is gross deduction, then the absolute amount of disallowance will be significantly higher as compared to a net disallowance. Based on a reading of the language, we feel, and our take is that 94B will apply on the basis of the gross deduction, which is view 1 that we have outlined in the charts to the right. Moving on, in terms of some more provisions that essentially deal with carry forward and set off, as Ashutosh mentioned, there is a so the disallowance under 94B is not absolute. When something is disallowed applying the provisions of 94B, then there is a mechanism to carry forward the disallowed amount for a period of 8 years, post which this can be offset. And what we've done is we have verbatim outlined the provisions that enable for this set off to be under subsection 4. As you would see, there is a lacuna in the manner in which the provisions have been worded, and there is no clarity on how and what is the mechanism or hierarchy to claim an offset. We've again tried to explain this using a numerical example. So if you look at the table on the left side, in year 1, the interest paid to an AE is 100 and the company had a negative EBITDA, and therefore applying provisions of 94B, the entire amount of interest paid to the related party would be disallowed, and the same would be eligible to be carried forward. In year 2, the interest paid to the AE, again on the same borrowing and applying the same rate of interest, was 100, and the EBITDA in that situation in this example was 500, and therefore the eligibility was 150. Now, I think what is very clear is that out of the 150 that is carried forward, 50 will be allowed to be offset in the second year. But the whole debate is on how is this 50 allowed, and what is the hierarchy of the claim of deduction in the subsequent year. So if you now see the chart on the right hand side, in year 2, when one is computing from a taxpayer's perspective, we would want to take a view that in the second year, the total eligible amount for deduction was 150, which is basically 30% of 500. And we would first seek to carry forward the first year's interest and offset it against the eligible amount, which means that we will use up the full carry forward and thereafter limit the current year's interest deduction to 50 and treat the balance 50 as amount eligible for carry forward to the subsequent years. Now, the advantage of this view is that effectively, if there is a cap of 8 years on the carry forward, each year, in a sense, we are offsetting the amount of interest first towards the carry forward amount, and thereby resetting the eligibility period for which the interest that is carried forward can be carried forward to. And obviously this is more beneficial because then it provides the taxpayer more number of years to offset the carried forward interest. The view 2, on the other hand, is to say that if the total interest deduction was 150, first you would claim the full deduction applicable for that particular year, which in our example is 100, and what will be eligible for carry forward and offset is 50, which means that you would have no amount of interest being carried forward in relation to year 2, and you would then be eligible to carry forward 50 pertaining to year 1, which then is the second year of the carry forward period. So again, absolutely no clarity. The provisions are outlined in the slide. There is no clear provision in terms of how this is to be done, and we will have to wait for some clarity or guidance to come out. But logically, we would think because of the manner in which the provisions are worded, view 2 probably is a more reasonable view, particularly because in the case of unabsorbed depreciation, where they wanted to treat unabsorbed depreciation as depreciation for the current year, the provisions are very clear and explicit, and therefore in the absence of explicit provisions, maybe the better view is to go with view 2. These are just some of the many provisions and lacunas or ambiguities that are there when one starts looking at the provisions and assessing their impact. But due to the paucity of time, we will keep it to these 3-4 key issues that we had outlined. And with this, I'll hand it over to Mukesh to take us through the remainder of the presentation.
Thank you, Kalpesh. And again, in the interest of time, we are just running about 8 minutes late, but we wanted to make sure that we cover it as many questions as we have. To the extent we are not able to cover all the questions within our allotted 1 hour, we will attempt to answer them and put it out. I mean, the overall take is really tax advisors and lawyers are in for fun times, frankly, if you ask me, with this legislation. But on a more serious note, I think Section 94B and India finally adopting Action Point 4 is a path-breaking tax policy directional change, and it has far-reaching impact on all forms of businesses that have traditionally used better leveraging structures using the debt route, particularly infrastructure companies, real estate sector. While earlier Kalpesh was telling me the kind of impact that it could have on solar energy related projects, which is one of the flagship infrastructure sectors for the current government. So I don't know whether there is an adequate thought that has gone into before embarking on this journey of thin capitalization rules. My personal view is that given the fact that foreign debt is controlled by the overall ECB limits, the purpose why the debt comes into India is controlled, the interest is controlled, I actually question the wisdom of Section 94B, but that's really my personal view. We have a law which looks like having very deep impact on all forms of debt-related transaction. The second point I wanted to make is that this is again very significant given the fact that April 1, 2017 also triggers off the introduction of General Anti-Avoidance Rules, simultaneously the secondary adjustments rules, and more importantly the amendments that have been featured into insofar as Singapore, Mauritius and Cyprus treaties are concerned. Now people may wonder what is the connection between amendment to these treaties and Section 94B on thin capitalization. Well, very simply stated, one of the implications is that the conversion of debt into equity is not grandfathered. So what do taxpayers do insofar as this regulation is concerned? So there are several questions that arise, and whereas it is fair to say that India is trying to embrace as many BEPS recommendations as it can, but clearly our tax laws are getting far more complex and it will play a very important role, even more strategic, as being a key influencer on deal negotiation. So obviously we can't get into all kinds of situations as to what impact we will have, but in the meantime we will throw the Q&A open. As we are speaking, several questions have come in. Let me try and direct the first question to you, Ashutosh. And the question is that Action Point 4 excludes projects of public benefit. If India had accepted the BEPS recommendation, then ideally shouldn't infrastructure projects have been left out, because right now the carve-out seems to be only for the banking and the insurance sector.
Yes, most certainly yes, Mukesh, because if you see the government is promoting infrastructure in a very big way, and ministers of the government have been proclaiming that renewable energy bids in India have been for solar and for wind power have been at historic lows. Now, have they been at historic lows? Yes, of course, because technology has advanced, and therefore the production of those particular capital items which generate this energy, the cost has gone down, but also because people are pooling in capital at low rates of interest, and therefore their cost structures are therefore lower. Now, in a post-2017-18, in a post-2017 scenario, if those particular structures are all getting attracted under this interest deductibility clause, then it will be very difficult for these infrastructure companies to keep their heads above the water in order to meet the particular per unit power which they have done under open auctions. So it's very crucial that the government, at least at the amendment stage, takes a power under this particular section to also exempt, besides the banking and insurance sector, which has been explicitly mentioned, to also exempt infrastructure projects of public interest, which the government can decide on a case-by-case basis.
Thank you, Ashutosh. Ashutosh, before I direct the second more difficult question to Kalpesh, let me answer two simpler questions. Question number one is whether Section 94B applies to domestic borrowings between two domestic related entities. The answer is no. The second simple question that I will jump to answer is exclusion from banking applicable to NBFC also? The answer is no, because an NBFC is different than a bank, and that's precisely the point that we have been making, which is that before the bill becomes a statute, it needs an amendment, and carve-outs, these are really precisely the carve-outs that we should be looking out for. Kalpesh, the next question is for you. Do these changes apply to existing structure, and what is the impact on existing infrastructure projects in your view?
I think there is no debate that these provisions will apply to existing structures as well. Insofar as these structures result in claim of interest deductions in years to which 94B will apply. So in other words, there is no grandfathering provision that has been made applicable in Section 94B. On the impact on existing projects, I think it is safe to say, in our view at least, that every capital structure that had elements of debt or elements of high debt would get impacted by this. In terms of the analysis that needs to be carried out, one needs to look at the play between GAAR, thin cap and transfer pricing rules as we spoke about. And in the analysis that we've been doing over the last couple of weeks, the impact is not small or insignificant at all, because mind you, there are a bunch of changes that are at play. One of them is particularly and specifically to infrastructure. Power producers are coming out of the tax holiday provisions starting this year. In other words, if you set up a plant after April 1, 2017, the tax holiday which was hitherto available is going away. On top of it, if a large or a substantial portion of related party debt and interest thereon gets disallowed, significantly you're going from a zero tax position now to a taxable position at the SPV itself, which then has a big impact on the return to the investor. Looking at different sectors, pharma where there are cases of levered acquisitions, real estate where where use of debt is very prevalent in case of foreign investment. Across cases, the impact is fairly substantial, in some cases to the extent of making the projects unviable on a post-tax basis, but in almost all cases to some extent or the other.
Kalpesh, the next question is also directed to you. Does the disallowance also impair the ability of Indian companies to repatriate interest to the lenders?
Yeah, that's where I think the whole interplay between thin cap rules and GAAR comes in. So what happens is, from a commercial perspective, if on a debt instrument we've worked with a structure of 90-10, 90 debt, 10 equity, and thin cap rules come in, and based on the formula, effectively we are ending up with a effective debt equity ratio of 60-30. We are looking at fairly interesting possibilities. So on one hand, the interest that you pay on the instrument itself is subject to SAR in the form of transfer pricing, because that's the rate of interest that one needs to look at. So let's say the structure worked with a 10% rate of interest, and the TPO came up with a 5% rate, just for the sake of this example. Not only is the 5% disallowed as per the secondary adjustment rule that is also enacted in this budget, there's an obligation on the Indian party to recover the excess interest so paid, or to pay deemed interest on it. On top of it, then you're looking at this thin capitalization, which effectively disallows the interest. But I would hasten to add that just because you've suffered a disallowance using the thin cap rules, it's not an automatic thing that the balance or excess interest paid as dividend. So from an exchange control point of view, you can still repatriate the excess interest as interest for purposes of FEMA. But there is a risk that the excess interest may get qualified or classified as dividends using GAAR. Even there, it's not automatic. We would then need to look at the totality of the circumstances to say that, is there a case to apply GAAR on top of two SARs, specifically in the form of transfer pricing and thin cap being applied.
Thanks, Kalpesh. I wanted to take one last question, but before I get on to that question, I just wanted to clarify one thing. This is something that our transfer pricing team has brought to my notice on the earlier question as to what is implicit and explicit guarantee. In relation thereto, I wanted to point out that there is a notification dated 18th of September 2013. This was rendered in the context of transfer pricing safe harbor rules, wherein they have gone and defined what is a corporate guarantee. And the corporate guarantee, they say, means explicit corporate guarantee. And it also says, for the purposes of this clause, explicit corporate guarantee does not include letter of comfort, implicit corporate guarantee, or guarantee of a similar nature, which really now reinforces the point that we were making earlier, that in the context of 94B, they clearly say implicit or explicit, which means that the definition of the term guarantee is clearly different for transfer pricing purposes and for thin capitalization rule purposes. The last question is an interesting question, all circling around what do you actually mean by saying loan? Will loan include a non-convertible debenture? As a non-convertible debenture is essentially a security. We also figured out that there is a recent decision of the tribunal in the context of section 269SS. Section 269SS essentially is repayment and acceptance of loans through account payee check. And a question came up before the tribunal whether debentures or are loans. And in relation thereto, the tribunal, while answering this question, made a reference to the Supreme Court judgment in Sahara's case. In Sahara's case, the Supreme Court had rendered a judgment in the context of Securities Contract Regulation Act of 1956, and it came to the conclusion that optionally fully convertible debentures are neither loans nor deposits. The tribunal took shelter of the principles laid down by the Supreme Court, although in the context of the Securities Contract Regulation Act of 1956, and said that optionally fully convertible debentures or convertible debentures or non-convertible debentures, whatever you want to call it, are neither loans nor deposits. So I think that principle will apply.
Okay, can I add to that? In the context of 94B, actually and interestingly, the language used is not loan, the language used is debt, and debt has been defined to include a financial instrument. So because of the change in the language and the manner in which debt is worded, my sense is that an NCD should get covered within the purview of 94B. Of course, on NCDs, there is a different set of issues that apply, because typically in a case of a listed NCD, the security is not to the lender, because FEMA specifically prohibits that, and the security is instead to the trustees. And by definition, some of these NCDs, and I'm talking more about the listed NCDs and not the unlisted NCDs that are eligible for infrastructure, by definition, these are freely tradable. So there are other arguments perhaps to be looking at to determine whether an NCD is covered and interest on NCD is covered under 94B. But as the definition stands, probably because the term used is debt and they use financial instruments, we could get covered.
Thanks, Kalpesh, for correcting me. Yes, I actually read out the correct judgment of Supreme Court, but I didn't read out the correct conclusion. So the conclusion is that debentures are loans and hence it will be covered. So with that, ladies and gentlemen, we come to a close of our webinar. Thank you very much for your participation. We are going to put out the recorded version of the webinar and the PowerPoint presentation. Besides sending it individually to all the people, it will feature prominently on the firm's social website, which is on the firm's LinkedIn account and the firm's Twitter account, where the handle is @BMR Advisors. Thank you very much for your participation and have a nice day.